Hi, everybody. So for those of you who joined us on Wednesday, the 13th of October for our live session one adventure, we had an incredible amount of tech issues. So what we decided to do for this session recording is to just re-record. So Dayton, Nicole, and I are meeting. We're going to go through the same slides that we went through last night, hopefully minus all of the tech issues. So let's go ahead and get started. And for those of you that did not join us last night and watching the recording is your first view of this, just pretend that you didn't hear anything I just said and everything went perfectly smooth last night. So this series, are you guys seeing the PowerPoint screen okay? Mm-hmm. Perfect. So this workshop is part of our Cornell Cooperative Extension Farmer Tax School. This is a series with 4 separate parts throughout the remainder of 2021 into January of 2022. If you're interested in registering for any of the other workshops, please let us know and we'll help you get set up with that. So this session is the first session part of income tax planning for firms that file a Schedule F. We are going to introduce all of the presenters. We'll talk about the outline for the evening or for this session, and then we'll go ahead and get started. So Dayton, do you want to introduce yourself?
Yes, I sure can. Hi, everybody. My name is Dayton Maxwell, and I work with the Capital Area Agriculture and Horticulture Program in Eastern New York, and I am a farm business management educator. And we cover 6 counties: Albany, Columbia, Greene, Rensselaer, Schenectady, and Washington. And it's my pleasure to redo this recording so you can see our faces and hopefully there's less technical difficulty today.
Perfect. Thank you. And Nicole.
Hi, everyone. My name is Nicole Tamel. I'm part of the Central New York Dairy, Livestock, and Field Crops team. I'm the Farm Business Management Specialist and also the team lead in that region. I cover 8 counties, Chenango, Fulton, Herkimer, Madison, Montgomery, Otsego, Saratoga, and Schoharie. So welcome. I'm glad that you're all here because it's really important now that we are in the 4th quarter to start thinking about our taxes and our 2021 season rolling into 2022. So welcome.
Thank you. And I'm Caitlin Wally-Stoll. I'm the Farm Business Management Specialist and team leader with the Southwest New York Dairy, Livestock, and Field Crops team. I'm the one that's been emailing everybody incessantly with all of the resources for this series. So thank you for bearing with me. We cover the Southwest New York corner, so Allegheny, Erie, Cattaraugus, Chautauqua, and Steuben counties. So for this session, most of these won't apply, but if we skip ahead, what we're going to cover is an introduction to tax planning. So kind of going over what it is and talking about the different types of tax planning. Then we're going to introduce the idea of tax planning goals and talk about the prerequisites to do some tax planning for your farm. So the things you have to have in place before you can kind of get to this planning step. A really important disclaimer that we want to start right off with is that none of us are certified accountants. We're not tax preparers, we're not lawyers, we're not legal counsel. So this information that we're going to present is with our best efforts. We did the best that we could to provide correct and up-to-date information. But at the end of the day, this is for educational purposes only. And you should talk with your legal counsel, your tax preparer on items that apply directly to you and your farm. We also want to thank our sponsors. Those will be included in the PDF of the slides that you'll receive. Their support helped us make this series affordable, offer scholarships, and we really appreciate them taking the time to support this series. Handouts that everybody's going to receive. You will get a PDF copy of all of these slides that you can print out, mark up on your own, and a copy of that sponsor directory. Everybody will get a copy of the Farmer's Tax Guide that we'll introduce later on, copy of the record keeping quiz that will be part of your homework. And if you need any of this information paper mailed to you, just let me know and we will send that out for you. Okay, so now I'm going to transition it over to Nicole, who's going to help kind of give us a foundation of tax planning and what's the point of it.
So I'm Requesting remote control or
You should be able to share your screen. Let me,
host disable participants
Okay.
screen sharing.
now try.
There we go.
Perfect.
Let me just, give me 1 minute. Okay, can everyone see my handouts or where it says what's the point of tax planning?
Yep, we're seeing
Yes.
presenter view side of it,
Okay.
which probably doesn't matter for this slide, but yep,
How are we now?
perfect.
Good.
All right, so what is the point of tax planning? Basically, our biggest concern is making sure that you're getting your farm's finances in order prior to January 1st. A lot of people typically wait until the last minute, and I know Dayton and Caitlin will both talk about that a little bit later, but trying to make some good decisions prior to January 1 is always really important. So the second one is looking at the overall health of your business. Being able to see, did you make a little bit of money this year? Where did your money go to? If you did not, looking at your trends, where you could potentially have, made some different decisions. So looking at the overall health of your business, having the ability to capitalize on potential after-tax income to minimize your tax burdens. That's another really good thought. If you have made a little bit of money, maybe you want to decrease your tax brackets. And again, Dayton and Caitlin will talk a little bit more about that a little bit later. But knowing where you are will help you forge a path forward in order to minimize any kind of tax implications, but also give you an ability to really focus on your business. So Dayton, I'm going to pop that back over to you.
All right. Thanks, Nicole. Caitlin, I may need permission to share my screen as well.
Yep, hopefully it just went through.
Okay, and I'm going to, can you see my screen?
Yep.
All right, let me get where. Okay, one of the things that we want to just let everybody know is that income tax planning occurs in the year, in the current year. So tax planning for 2021 will occur in 2021. And the timing of our course is very particular to our suggestion to you to begin tax planning in September or October. So at the end of the third quarter or beginning of the fourth quarter of the year, we think is a really good time to do income tax planning. And this is my last statement here. More often, December, the week between Christmas and New Year. I'll talk more about that later, but that's been kind of a fun experience that I've had with my farmer friends that do last minute income tax planning. All right, so let me back up. So essentially what you're doing is managing the amount of income tax that the farm business pays. And as we'll see in week number 2, the Schedule F line 34, the net farm income flows into the federal 1040 and can influence what the farm pays, or in general, what the family pays based on whether or not there's other income coming in, such as wage income. And of course, using the cash accounting method. And again, another message here, be advised that successful businesses pay income tax. And I have some farmers that I work with that will do anything not to pay income tax. And one farm in particular that I work with, they The machinery dealers love them because at the end of the year, they will finance a piece of equipment so they can never, ever pay taxes. And I appreciate that. However, one of the things that they've done is create this, this overhead cost of debt payments through this avoidance of tax that has kind of created some fixed costs for them. So, and they make it work, but I caution them about this every time we meet. So, but the machinery guy loves them. All right. So what we're doing is essentially managing how much the farm business contributes to overall income tax liability. And again, the combination of a farm business and a wage income or things like that. That's again, trying to manage the income tax liability. And some farmers will do anything to avoid paying income tax. And again, the message here is profitable businesses pay income tax. So please don't be that person or that business that avoids income tax at all costs. Really what you're doing is you're making a choice. If I have an income tax liability, do I try to lessen that by reinvesting in the farm business, or do I pay the tax liability? That's the big question. Reinvesting or paying the state and federal government. And it really is a balancing act. And again, reinvesting warms my heart a lot more than paying the state and federal government. So again, balancing act, which we'll talk about. And this is federal tax brackets. Just take a look at it quickly. And one of the goals, or the goal we think about of income tax planning, is to get our taxable income into a different tax bracket. And again, all depends on how you file your taxes, whether you're single, married filing joint, married filing separate, which is very similar to a single head of household, etc. And these numbers here, for example, the 9,950, the 19,000, these are taxable income amounts of which your tax is based on. So if we think about it, a farmer may try to go from a 12% tax bracket down to a 10% tax bracket. I would say probably a more common one would be to get from the 22% federal income tax bracket down to the 12%. So really, by managing our taxable income, we're trying to get into a lower tax bracket, and therefore pay less or have less of an income tax liability that I think Paul will talk about in class number 3, but the income tax liability can be offset through various credits and things, but Paul will talk about that, our tax preparer, in class 3. And so the next 2 slides, we just have some basic venues through which income tax liability can be lowered. Again, trying to get into a different tax bracket. One is rapid depreciation or general depreciation of a capital purchase. And a capital purchase is the purchase of an item that has a useful life of longer than 1 year that you'd use in your business. And we think of equipment, cattle, buildings, things like that. The IRS will let you depreciate the purchase cost of those over time. One of the things, rapid depreciation, section 179, you could depreciate the full cost of an item, I think, as long as it's less than $1 million in the year it's placed in service. So you can really use depreciation a lot through capital purchasing to offset tax liability. Prepaid expenses are another way to do this, and meaning I'm paying for expenses. I'm incurring expenses in 2021 that I will actually use in 2022. And the tax rule is that my 2021 expenses, up to 50% of those expenses can be for next year. So I can pay for things that I now in 2021 that I'm actually going to use in 2022. And this is one of my favorite things because it really directly influences the liquidity of a business, and you're really investing in liquidity, in the future liquidity. and that's what wins. So I really like that. Just a caution here, beware of a snowball effect. I work with a farm, very strong financial business that prepays every year. Once you get into that cycle, they really cannot get away from that. And even through some bad years, they still are prepaying. A very low debt business, high earnings. But some of their bills, for example, their grain bill, they won't have a grain bill till July or August because they prepaid all that way. So that's kind of a neat thing. Employee retirement plans are a way to do this. A simple IRA, SEP IRA are ways to reduce taxable income and invest in your employees and the owner. So deferring income is another way to do this. And just give you a quick example. Large dairy that I worked with last year, they told the milk company to hold their December check until they didn't want it till 2021 because they didn't want to report the income. So just an example there. Income averaging is a tax law that lets you take some profit from this year and average it back over the most recent 3 years, prior 3 years. If you have a great year this year, you could income average and put some of those profits back into maybe had some bad years in the 2 or 3 years prior. Another option here is capital leasing. And leasing isn't as popular as it used to be because interest rates are so low. If you do the analysis, in a lot of cases, leasing is more expensive. However, leasing is available. And a lot of companies, whether it's equipment or building companies, will let you do a capital lease, say in December, and they'll front load the payments. They'll have a balloon payment up front where you can pay a big balloon payment at the end of the year and include that directly on your expenses. Your operating expenses as a capital lease can be written off as an expense. So those are just some methods to invest in your business and lower taxable income. And we just want to, the next few slides, we just want to compare some types of tax planning. Income tax planning considers the operating cycle for a 12-month period. And again, you're managing the income that is generated and the expenses that are incurred and the net income for that 12-month operating cycle. And this is typically a calendar year. Most farm businesses operate on a calendar year. As compared to capital gains tax planning. In a capital gain, let me just give you an example. So I'm working with a farmer right now, or spoke to him recently, and he's an elderly gentleman, real sharp guy, bought a farm in 1963 for $10,000, and the estimated sale price today is $600,000. So there's been a huge amount of capital appreciation there. So that, let's say this person sold his farm for $600,000 would be the sale price. And his basis, what we would call basis, was the amount he paid for it in 1963. So that's $10,000. So he would have a capital gain there of about $590,000 if he sold that property. So capital gain considers sales of capital assets rather than the 12-month operating cycle. One of the things we look at with capital gain sometimes is a thing called recapture depreciation. And recapture depreciation is, let's say, I bought a tractor for $10,000. I depreciated $5,000 of that tractor, and then I sold that tractor for $10,000. That $5,000 that I depreciated, which was regained through the sale of that tractor, would be called recapture depreciation, which is taxed at regular rates. Usually depreciation recapture is a non-issue with items that depreciate. However, capital gains can be really significant when we're talking about land, the sale of land. So that as compared to income tax planning. Another type of tax planning that we do is gift and estate tax planning. And this is the maximum value that a person can gift during their lifetime or at death. And just these are the guidelines. And the neat thing about gift and estate tax planning is the gifting person pays the taxes, not the receiving person. Very interesting. So the maximum asset value which can be transferred before taxes in 2021 is 11.7 million on the federal level per individual. So if you had a husband and wife, it'd be about 22 million. 5.9 million on the state level before any taxes are incurred. And this is again individual. So if we have a husband and wife, we're looking at about 12 million. But if we get over that, anything over that, well, at least the federal tax rate is 40%, anything over that amount. The state tax rate has kind of a range, so I didn't get into that too much. And not to get off track, but one of the concerns right now is that the administration in Washington, D.C. is looking very hard at changing these, which could possibly influence family farms. Although I've heard that legislation is kind of stalled out, which for family farms is good. Right, and just some long-term capital gains, and long-term is anything held more than 1 year. And again, depends on your filing status, single, married, filing jointly, etc. Looking at a single person could have up to $40,000 capital gain with no capital gains tax. If we think about the person I was speaking with recently, we're looking at, he's a married filing joint, and his capital gains was going to be almost 600,000. So we said, well, you may as well figure on capital gain of $20,000, and the state tax was about 5%. So between federal and state, we're looking at about 25% capital gain through the asset sale of that farm property. Yeah. So Nicole, do you want me to, you want to switch? This is you.
Yep.
Do you want me to get out of here? Okay.
Yep. Go right ahead and get out and I will switch.
Okay. Let me see what I can do. I have to stop screen share, right? Yep.
Mhm.
All right. There you go.
Thank you.
Yep. Welcome.
Okay. What are your planning goals? Can you see that?
Yes.
Fabulous. Okay. So, Dayton just gave you a really nice background of some ideas and how your income works. So taking that knowledge and kind of applying it to now, we need to look at your goals. When you're going into your fourth quarter, people start to look at potentially refinancing or restructuring some of your loans. Folks tend to do this right now. Our interest rates are low, so there's a lot of folks that are starting to look at refinancing, maybe bundling some things together and restructuring their loans at that lower interest rate. They're looking maybe to access some capital because they're thinking of maybe expanding their farm business or diversifying with some new opportunities in lending, or even some new business opportunities. There are folks that are identifying needs. We had quite a few folks in 2020 during COVID that identified some needs, especially some of our smaller farms, and they had the ability to go ahead and access capital and potentially have some new interesting business ventures. So utilizing your income and looking at some planning, you can identify and grab some goals with that. The other thing that Dayton spoke about was decreasing your tax liabilities by prepaying those tangible items, forward paying grain bills or seed costs for next year, fertilizer costs. There's always lots of fertilizer costs. So people like to prepay those. And then of course, with COVID and just the ag industry in general, we always are seeing some exits and some transitions. So maybe you're at the point in your life or in your business cycle that we'll talk about where you potentially are thinking about unwinding your business, having some planning some goals basically worked through. Will help with some exit strategies, or maybe you want to transition your business to another generation or pull in an outside partner. So looking at the overall health of your business, looking at where your goals are and where you see yourself down the road could potentially help you with some transition strategies. But all in all, it's really important because identifying those goals within your business will assist you in that next phase. And your tax season is a great time to gauge the health of your business. So you could kind of see your past performance. You can budget and plan for the last quarter of the year, looking at all of your income and expenses, looking at the futures markets, and then planning your 2022. A lot of lenders want to start planning your 2022 and looking at your needs. So identifying those goals in your business are really, really important. The next thing is, basically, which I just mentioned, was where is your business in this business cycle? Now, I realize that this is kind of sales and time, but I did ask last night how many people have seen this before and have seen kind of the business cycle. So taking a peek at the business cycle and trying to determine where you are is really what should be driving your conversations with your accountants. So, are you still in that introduction stage or the growth stage? And where that's happening is, you're increasing sales, you may have you're reducing costs, you may be paying down some debt and creating some equity for yourself. So where are you in those stages? And then, of course, just like I had said previous, looking potentially at that decline stage, your exit strategies, transitioning. So really focusing on where you are in your business is going to help determine all those tax conversations with your accountant. So moving from that, we like to talk about the pitfalls and perks of your Schedule F with profits. Dayton focused pretty heavily on got to go back one. Dayton focused pretty heavily on the importance of showing some type of profit on your Schedule F, and there's reasons for that. And a lot of it has to do with lenders questioning your viability and the eligibility of your business. If you aren't showing a profit, or obviously they're going to have some grace when it comes to, low margins, low prices, maybe if your business is new, but if you are showing year over year pure losses, they're going to start to question your viability and the eligibility of your business when it comes to a good financial risk. There are institutions out there that will grade you on this, and they will pull your loan if they don't feel as that you're a good financial risk anymore. The other thing is potential IRS audits. So year over year losses tend to create red flags, especially if they're really extreme losses. So trying to stay away from that IRS audit base is good for you. And the other one is, are you generating enough income to not be considered a hobby? I know last night some folks were asking what exactly was a hobby farm. The US government determines that to be $1,000 or more in income. We typically like to say we want you to see $10,000 of gross income because that just puts you on a level playing field for ST-125s or agricultural exempt decreases in your taxes. So there's that $10,000 level is kind of where we like to see that you're really not a hobby versus a small business. However, it's not set in stone, those numbers. Those are just kind of numbers we like to look at. But it's also how much time are you investing in that business? So are you really there working that business? I believe it's like 2/3, I think, that you have to put in, or 50%. There is some time that they want to see you spending doing that business. So are you generating income to not be considered a hobby? I did have a farm once, not too long ago, that was flipped from, they thought themselves a small farm. They changed accountants. It ended up being an absolute mess for them. And they were considered now a hobby farm, a hobby, not even a hobby farm. It was a pure hobby. So they had to go and do a lot of changing and restructuring and visiting with accountants and attorneys in order to kind of eliminate some of this mess, and they're still in it. So you want to really work with a good lawyer or a good accountant so that you don't have these problems. The other thing is positive track records in farm revenue for the IRS. Like I said a little bit ago, lenders are more apt to assist positive profit businesses, capital expenditures, purchasing capital expenditures, growth and expansion. Think of it just like your credit score. Lenders look at those things. They're going to look at you personally. They're also going to look at your business. So you want to have something that's profitable. They want to make sure that you can repay the loan in which you are asking for, or purchasing a vehicle or a piece of machinery. If you aren't showing positive profit or having positive cash flows, you may be less apt to get any type of assistance, and that's going to really hinder any growth or expansion of your business. So that being said, I believe it's going to go back over to Dayton. So I'm going to stop share. Go ahead, Dayton. You need to unmute yourself, Dayton.
How about now?
Much better.
Good, thank you. The next couple slides just going to compare income tax planning in a good year versus a bad year. And what we mean by a good year is a year where earnings, profits are very favorable. So might consider in a good year beginning in income tax planning a little sooner than we recommend. We typically recommend right now. However, in a good year, you may think about it in the middle of the year, June or July, or the middle of your fiscal year. All right, let me see. Might need to, for some reason, my slides do not want to advance. Let me, oh, here we go. There we go. And so what I would suggest doing, and this will require some budgeting, to do some budgeting forward, to think about if we don't do any tax planning, what are our earnings going to look like, and therefore what will taxable income look like, and also compare that to, through budgeting, if we do income tax planning, what does our taxable income look like? So again, this may require you to work with some financial professionals, people like Caitlin and Nicole and myself, or tax prepare, or Anna Richards, or any of the gang that are sponsorship people, of course. Yeah, so what about a bad year? Bad year, I would say, is less of a concern than a good year, meaning there's less earnings. So starting at the ideal time, September, October, is okay, and may use a bad year to offset tax liability through income averaging. So if this year is a poor earnings year and next year is a really good earnings year, you may be able to offset some of next year's earnings because this year was not great from an earnings standpoint. All right. Pros, get into some pros and cons. again, minimizing the tax liability meaning the amount of tax that you owe. And I talked about this last night, but I'll just address it again quick. This is a picture of the clock tower at Cornell University. And on that clock tower is a big pumpkin. And that happened, and I joked last night, you could guess my age because I was hanging around Cornell at that time. And somebody put a pumpkin on top of the clock tower. And the big mystery is, how did it get there? And I'm pretty sure it got there. A person climbed up the inside and made his, a professional rock climber. So the story goes, but that's what I heard. I don't know if Caitlin heard anything else or not, but that's what I heard. So the advantages of minimizing your tax liability: planned investment versus reactionary investment. Meaning if you're starting in the fall, you know you're going to have a tax liability, you know you need to spend some money to offset that tax liability, you can do some strategic spending. And what I think about when I think of strategic spending, it's spending that will help me generate more revenue or decrease my operating costs. And that's strategic spending. And this kind of just improves overall business management and forces you to be a better manager. Disadvantages, let me see, let me back up. Let me move this if you're looking at my screen. Disadvantages of minimizing your tax liability: you have to make time to do it. There's additional costs for financial and accounting people. And we'll get over to next slide here. Let me just move this. Some more advantages: pay less income taxes, invest more in your business, and manage self-employment tax. So self-employment tax is what we think about when we think about Social Security and Medicare. So if you're an employee of a business, the employee pays half, I think, which is 7.65% of Social Security and Medicare, and the employer pays half. But if you're self-employed farmer, you are responsible for paying the full 15.2% of self-employment tax, which is the Social Security and Medicare. A couple advantages here. One advantage is you get to actually expense the employer side through on your operating statement, the 7.65% that the employer would normally pay. The other advantage is you're paying into the system, Social Security system. So when you get to retirement, you have paid in. So if you're looking for an income stream in retirement, you've paid into Social Security, you can draw that. I work with a farmer who very rarely paid in, very proud of never paying taxes, and they're in their early 60s and they want to retire, and they say, well, I'm not eligible for Social Security. And I say, well, you never paid in. So anyway, that's an advantage. All right, disadvantages: you need good financial records to do this, and that may involve a professional. And this is kind of in jest. Reduces New Year's Eve road trips. And what I mean by this, I have a good friend who he's my neighbor, and he's a farmer. He's a really good farmer, but he does his tax planning kind of last minute. Seems to work for him. But what he'll do, and he's done this for years, he'll call me up, right around the December 21st, and he'll say, hey, after Christmas, we got to take a whole day and we have to go look at this tractor, and it's 8 hours away, or this chopper or something like this, and you have to go with me. And of course I love it because it's guy time away from, guy time away from home. And I always have to sell this to my wife, and she says, well, you really need to go. And I say, oh yeah, I have to go. I have to go. So my good friend and I spend a day in a really nice pickup truck, chatting it up. And kind of the rule is that what's said in the truck stays in the truck. And so if you tax plan, there's less opportunity for these trips. Anyway, that's kind of a joke that for me would be a disadvantage. All right, what does the IRS look for? The IRS looks for consistency in the amount of income tax paid to avoid an audit. So that's what they look for. If you're consistently paying a regular amount, they in all likelihood will not bother you. If you pay a very small amount and a very high amount, they may question the integrity of your tax preparation. And let's see, managing income taxes to access credit. All right, let me just talk about these. So lenders, if you have ever applied for a loan, and I worked in lending for a number of years, one of the first things I'd ask a farmer for, a new farmer that I haven't worked with, I'd say, I need 3 years income tax return for the prior 3 years, and I need your Schedule F. And it's very important for those income tax returns to show a positive net income, positive earnings. Quick example here, I was working with a farmer recently. He called me up and said, I can't get a loan. All the lenders are turning me down. I said, let me see your tax returns. And for the previous 3 years, those things were disastrous. He had tremendous losses. I mean, like, $80,000, $90,000 losses, and it was crazy. And he had some depreciation there. And of course, he liked it because he was getting lots of money back, showed these losses, and he's getting money back from the Fed. So anyway, I said, if you want to get a loan, you got to get your taxes amended. So we did. And we kind of walked through that together, and he got his taxes amended, and he is now approved for a loan. So we kind of changed that situation around. Here's the advice. If you're going to manage your income tax liability and you want to also work with a lender, depreciation is the venue to do that. So income tax liability managed through capital purchasing of tangible long-term physical assets in your business is the way to work with a lender. The reason is because the lender is going to add depreciation back to cash available, because depreciation is a non-cash expense. And even if your Schedule F is showing a loss and we have a really strong depreciation expense, we can add that back to show funds available for debt service. So summary statement, if you're working with a lender and also trying to manage your tax liability, use depreciation. So capital purchasing. Yeah, all right. And that's, Nicole, is that you?
Me.
Okay, Caitlin, so let me, I'll get out of here. Stop share. There you go.
Caitlin has the last part.
Okay.
Okay, there we go. So at this point, this is a good spot to pause the video if you need to take a deep breath, walk away from your computer screen or your phone, whatever you're watching this on, and come back to it. But now we're going to move into talking a little bit more about some of the prerequisites to income tax planning and working with a farm accountant. So if you need a fun game to play at home or when you're bored driving around in the tractor, what we did is think of one-word answers when you think about farming, but the twist is that you have to go in alphabetical order. So for example, when I think about farming, A comes to mind is apples, and B might be business planning, and see how far you can make it down the alphabet. So what we're going to start with quick is a introduction to the farmer's tax guide. So you've heard us reference this a couple of times. What it is it's an official publication directly from the IRS. It's Pub 225. It explains, and this is the definition directly from the IRS, it explains how federal tax laws apply to farming. It defines what farming is from a tax perspective. And it also includes information related to record keeping, how long you should be keeping records, what records to keep, and some other business management things. So this is included in all of your handouts, but just to briefly give you an idea of what it looks like. It's 94 pages of super exciting reading. So, and the newest version is not out yet, but once that's updated, if it's updated during the series, we'll let everybody know. So as you'll see, it covers, record keeping, different accounting methods, farm income, and determining what that farm income is, and gets into some more of the nitty-gritty pieces of preparing taxes as a farmer. So thinking about, hopefully, as you made it through this presentation, we've convinced you that income tax planning is a good thing, that it's helpful for you to use on your farm. So now you might be thinking, how do I even start? Am I ready to start thinking about income tax planning? And from my perspective, there's kind of 3 prerequisites to income tax planning. Those are, having access to sound financial records, having a solid bookkeeping system in place, and having a good relationship with a farm accountant. So going through each of these individually, sound financial records, what we mean by that is that you are using your financial records to monitor the progress of your business. Are you meeting your financial goals? Are you looking at those more than, it's more than your Schedule F at the end of the year? Are you doing some type of record analysis throughout the year? Are you putting together financial statements? So things like a cash flow statement, balance sheet, income statement, and are you putting those together and looking at those? If you are, that usually means that you've got sound financial records already in place. And having sound financial records also makes it easier to prepare your tax returns come time to do that. And you're not going on April 12th trying to dig through shoeboxes of receipts, right? So you've got sound financial records that you can work with your accountant because you've already been looking at them throughout the year. Moving on to solid bookkeeping and how this plays into income tax planning. So having a solid bookkeeping system in place, and there's no requirement for it has to be done a certain way. So this ranges from an organized file folder. It could be an Excel sheet. It could be a notebook. It could be some type of online program like QuickBooks or Quicken, or it could be hiring the bookkeeping part of your farm out. So maybe you are working with an accountant that's preparing those records and doing your bookkeeping for you. Whatever bookkeeping system you're using, what we want to see is that it's clearly recording income and expenses. And then along with recording those transactions, you also have a backup method and a safe location of where you're storing your supporting documents. So things like your invoices that you've paid, receipts from any farm sales, contracts related to things like farm rentals, loan payments, and records of those. So it's twofold. You have to have your accounting ledger, but then you also have to have those backup documents stored safely as well. A solid bookkeeping system is also updated regularly. So this doesn't have to be daily by any means. And it really does depend on the size of your farm. So your record keeping schedule might look like, once a week on Sunday nights, you sit down at the kitchen table, you file away receipts, you pay bills, or it might be once a month, depending on the size of your farm. As long as there's a consistent schedule and it's not all happening on, the last 2 weeks of December, what we want to see is that it's happening throughout the year. And the other important piece of this is that there's a designated person for your farm business that's responsible for bookkeeping. So what can happen is if you've got 2 or 3 different people in the farm that are working on bookkeeping in some capacity, so maybe one person's paying the bills, one person's supposed to be filing receipts, and then the other person is supposed to be preparing financial statements. There could be some overlap in things that get missed just by thinking, oh, I thought that was your job, it's not my job. And having one designated person is really important. And then the other component of solid bookkeeping that we want to have in place is that you have a way of tracking assets and other balance sheet items. So you are regularly updating, the purchase and sale of different capital assets, your accounts payable, your accounts receivable. You have a record of all of those items. And then the third prereq for income tax planning is having a good relationship with your farm accountant. What we want is for you as a customer to understand the services that your accountant is able to offer. So if your accountant can only do, files your income taxes and that's it, that's not going to be good for income tax planning. You need somebody that you can access throughout the year rather than just income tax time. You also want a farm accountant, or an accountant that's familiar with farm taxes and particularly the Schedule F. So accounting for farms is done on a cash-based system, whereas for everybody else, it's accrual. And that transition between different accounting systems can be tricky. The other thing is that farms have access to very specific tax benefits, which is one of our sessions, shameless plug. So course number 4 as part of our tax series is all about tax code benefits for farms. If your accountant, though, isn't familiar with working with ag businesses, they're not going to be up to date necessarily on what types of credits you might have access to, or how different types of equipment might be depreciated, or how you're going to claim the sale of a raised animal versus a purchased animal. And all of those are really important to consider. So working with a farm accountant that has extensive experience working with farms is so important. You also want somebody that is willing to assist with audits. So, my nightmares consist of letters from the IRS saying we're auditing everything you've ever done. That might just be me. But if this is also a concern of you, you really want to have a farm accountant that's going to be there. And in the case of a worst case scenario of an audit, they're going to help guide you through that process and help you pull up the documentation that you need. And you want a farm accountant that's really there to support you as a person and your farm business. So you want to be more than just a number to them that shows up income tax filing time. Somebody that is familiar with your operation, somebody that's willing to attend meetings and help you decide different decisions moving forward about your farm is a really good sign that you've got a good farm accountant. And we kind of already alluded to this, but having a farm accountant that can help you with financial analysis will help you get ready for income tax planning. So this might look like running quarterly balance sheets and income statements. And once they're able to run those numbers and those financial statements for you, you can then use that data to move forward with different planning efforts. And this one's probably my little extra fuzzy feely thing, but somebody that you feel comfortable talking to. So income tax planning, sharing your number, sharing, what your farm is doing financially is a very private thing. And having somebody that you feel comfortable talking to, comfortable asking, like, what do you think? How can I make this better? How can I make this more profitable? That's so important. So I always say, I want my farm accountant or ag service people that I'm working with to be the same people that I would see at the county farm bureau picnic, or somebody that, I would go down to the coffee shop and drink a cup of coffee with. Someone that you feel comfortable with as a person and you feel confident with as a farm accountant. So this is part of your homework, but what we would like everybody to do is kind of reflect on your current accountant and see, are you in a place with them where you can do some financial income tax planning? So 4 questions to ask. The first one would be, how many times a year do you see them? So do you only see them once a year come income tax planning time, or do you have quarterly meetings set up with them? How many questions do you ask them? So do you feel comfortable coming with a list of questions of, I made this purchase and I don't know how to file it, or we're thinking about doing XYZ. How would that affect our income taxes? How would that affect our balance sheet? And again, do they work with a lot of farms? So if you're working with an accountant and you're, one of 2 farm clients that they have, they might not have all of the up-to-date information as it relates to filing your taxes as a farm business. And finally, this is the Caitlin fuzzy feely question. Would you see them at your local coffee shop, your local diner, your community picnic? Is it somebody that you feel comfortable talking to and working with? So those are kind of the 3 prerequisites for income tax planning. But at the end of the day, we're telling you income tax planning is important. We're telling you that making goals for your farm is important. We're saying, get these 3 things in order so you can do income tax planning. But at the end of the day, it's really up to you, right? So why bother? Why do I want an income tax plan? And this all comes down to, what are your specific income tax planning goals for your farm? So we have already introduced some different goals. And what we want everyone to do is kind of reflect on what are those goals for your farm specifically? Okay, so now we're going to give everybody some homework to do between now and session 2. The first piece is that everybody received the Rate Your Record Keeping quiz. This is an amazing, fun, very quick kind of self-assessment to go through, developed by our super awesome colleague, Mary Kate McKenzie. And what it will do is help you to see how you're doing with your record keeping and where there might be opportunities to improve or discussions that you should have with your farm team. Next, we're giving everybody a copy of the Farmer's Tax Guide. It's huge. You saw me scroll through it. What we want everyone to do though is just glance through it, get a little bit familiar with it and see if you can find 1 or 2 things that might be new information to you. Is there something that you could have been claiming that you haven't been claiming? Is there some record that you need to be keeping for 7 years and you've only been keeping it for 1 year? So just take a look through it and see if you find anything interesting or new to you. And then what we want you to do is reflect on the accountant relationship article that will be provided and think about, how does this affect your current farm accountant? Are you satisfied with the services that they're offering? Do you need to give them a call to see if they can offer more services, or do you need to, talk to your neighbors and see if maybe switching to a different accountant is going to be better for your income tax planning goals? And then speaking of goals, we would like everybody to really narrow in on what are your specific farm income tax planning goals. And by having that goal in mind, it's going to help you kind of navigate through session 2, which is we're going to get into some really nitty gritty stuff of the Schedule F, the nuts and bolts of income tax planning, and session 3, where we're featuring an actual tax accountant super guru from Farm Credit East that's going to be able to provide some really tangible examples and experiences for you. So in conclusion, tonight we talked about income tax planning and what it is. So managing the tax liability of your farm to meet your planning goals, which supports your overall farm business goals. We talked about how to manage your tax liability, and how you manage that will change depending on your projected profits for a year. So what you do in a good year is going to be different than what you do in a bad year. And hopefully everybody's might be a little bit on board with the idea that claiming a profit isn't a bad thing. Especially considering what your future lending goals might be, growth goals might be. Paying a little bit of income tax can be okay sometimes too. And we talked about the prerequisites of income tax planning. So those are having sound financial records, having a solid bookkeeping system in place, and having a really good relationship with an accountant that specializes in farm taxes. So everybody's got some homework, some reflections to do. Let me go ahead and stop my screen here. And what we'll do with this recording is we'll email it out to everybody, get a chance, so you have a chance to look it over before session 2. And in session 2, as I mentioned, we're going to get into the nitty gritty of Schedule Fs and income tax planning. So at this point, Dayton, Nicole, do you guys have any other last thoughts to add in here?
No, I'm good. Thank you though, Caitlin, for asking.
Yeah, I just want to say it's hopefully people can watch the program and see us and hear us this time.
Perfect. That's what I'm hoping to. So we're going to go ahead and end this recording, and we hope to see everybody at session 2. Thank you.
Thank you, everyone. See you on Wednesday.